All right. Back in the saddle here in ACC230, Unit 40998. We're going to go into Chapter 5. I apologize for missing class last Tuesday due to my bad foot. I had to go up to the urgent care and spend hours up there waiting for them to get an x-ray done and figure out why I couldn't walk. So anyway, let's just wait a minute or two and see if we have some students show up. If not, I'll get started on Chapter 5. Because of my absence last week, we're running up against a little bit of time pressure. So we'll do Chapter 5 today. Chapter 6 will be our Thursday assignment. Those two chapters merge together. And I'm thinking that might be a good day for a test, depending on what Professor Alsheimer thinks and what the remaining schedule looks like. So I guess since there's nobody here yet, I'm going to get started and see if we can get into Chapter 5. Merchandise operations. Merchandising operations, multiple step income statement. Wow, they have 6 things they want us to try to understand, huh? Let's see if we can get into the first one. Describe manufacturing operation, merchandising operations, and inventory systems. Okay, what's a merchandiser? Person who buys and sells. A store is a merchandiser. Walmart, Amazon, Office Depot, etc. And the source of income for a store or sales revenues or sales. And what we're going to learn in this chapter is we have a new elongated income statement called the multiple step, where we're going to take sales, subtract cost of goods sold to get gross profit, and then subtract operating expenses to get net income. The multiple step income statement, you're going to come up with gross profit, operating profit, net profit before taxes, and tax and profit after taxes. Talk about the operating cycle, the flows of costs. Perpetual inventory system. There are 2 systems we're going to be studying. One is called the perpetual and one is the periodic. The perpetual inventory system is one in which you always know exactly how much you have of every inventory item in stock, and you know what the cost of goods sold is on the things you've already sold. So with a perpetual inventory, keeps detailed records of each purchase and sale. You should know what's on hand and know what the cost of goods sold is. You call up a store that's on a perpetual inventory system, such as Costco, I'm sure they are. You call them up and you ask if they have 10 70-inch screen televisions available for sale. That person will just hit a button on their computer, call up that part number, and it will tell them exactly how many televisions are available. If they were on a periodic system where you're not recording the cost of goods sold or the inventory reduction, you wouldn't know, and you'd have to go in the back and look. The periodic does not keep detailed records of goods on hands. It determines cost of goods sold by account. Under the periodic system, we have to take a physical count at month end and then subtract that from the goods available for sale to come up with the cost of goods sold. Under the perpetual system, you're recording the cost of sales on a daily basis. A lot of advantages, obviously, with a perpetual system. Used for merchandise with high unit values, shows the quantity and cost that should be on hand at any time. You've got good control over your inventories. And one nice thing with a perpetual, you may not have to take a physical count at the end of the year if you think your perpetual system is reliable. What we used to do for many years with our perpetual system at Thomas & Betts is we counted every day. Every day we counted maybe 3 items. I'd send somebody down from the accounting department, count these 3 items. They'd come back with the physical count. We would compare them to the perpetual. And if they were in agreement, we felt we were in good shape. Once in a while, we'd find one that was where there was a difference between what the perpetual said we had and what we actually had. We'd carefully research that. And if we found we had that happening more than we felt comfortable, it was time to schedule a complete physical inventory. So our first objective was understanding what a merchandise business. Record purchases under a perpetual system. Purchases under a perpetual system. Well, there's an invoice, a purchase invoice. Record purchases of merchandise. Well, we bought something for $3,800. We debit inventory. We credit accounts payable. All right, not too tough there, going back to our earlier chapters. Let's start to understand FOB, freight on board, freight on board. FOB, shipping point, FOB destination. FOB is the point in time where title from the goods pass from the buyer to the seller. It's a very important concept to understand. In other words, FOB, shipping point, means that as soon as the goods are shipped, they're owned by the buyer. I bought goods from you in Santa Barbara, but it's FOB shipping point. As soon as that truckload of goods left your campus and headed to me, it had an accident down here near the 7-Eleven down the street, and all the goods were damaged. I'm responsible for that. My insurance was covering that shipment. I owned it because it was FOB shipping point on its way to me. If the same thing happened, then it was FOB destination, and the goods were destroyed in an accident 1 mile outside my store in Newark, New Jersey, I don't have to worry about it because the goods still belonged to the seller up to that point. So get familiar with FOB. It's going to come up later in test questions and some other concepts. Assume delivery of the goods on May 6th. SOC pays Public Freight Company $150. SOC is the company that purchased the goods. SOC is the person who purchased the goods. So we debit on a perpetual system, we debit the freight charges directly to inventory. Freight is part of inventory. Now, if the shipper had paid the freight, that would be a selling expense for them called freight out. Let's understand purchase returns and allowances and purchase returns and allowances and purchase discounts. We've all sent something back to the store because we received a gift that didn't fit or was the wrong color or something. Purchaser may be dissatisfied, the goods are damaged or don't meet expectations. We return them to the store for credit. Or the store may say, look, we don't want to give you a full refund. How about we cut the price in half and you keep it? That would be a purchase allowance. Under the perpetual system, when SOC returned goods costing $300, he credited inventory, because that's what was sent back, inventory, and he debited accounts payable, because we don't owe the $300 anymore. So we're going to use the word inventory on purchase returns and allowances for a perpetual system. In a perpetual inventory system, a return of defective merchandise is recorded by crediting, and the answer is inventory. Under a perpetual system, we're not going to work with purchase returns and allowances at all. Purchase discounts, Purchase discounts. Companies often offer these discounts to customers in an attempt to get them to pay quickly. And what happens here is, oh, hi, Derek, how you doing? I just noticed you joined me here. So I'll continue my speech here. Can you see the PowerPoint, Derek?
No, I can't.
Okay. Here it is here.
Yeah,
hey,
no.
Now you can see it?
Yeah.
Okay, now we'll catch up. I was working without a net there, but I think we'll be okay.
What chapter is this? Chapter 6?
This is chapter 5.
Chapter 5. Okay.
Yeah, we're just a little bit behind. We haven't gone through chapter 5 yet, I don't believe. So that's where we're heading right now. Hey, can I make a suggestion, Derek? Since I didn't have the shared screen, why don't we both get out and go back in again, okay? We'll start over. Is that okay, Derek?
But you're okay if you want to continue from here. Because
Okay.
I'll probably
Okay.
have like 30 minutes.
Okay. All right. We'll continue then.
Okay,
Purchase discounts. Companies offer discounts to spur quick payment. 210 net 30. We have to understand how to read these things. 210 net 30. 2% 10 net 30 is how that's read. 2% 10 net 30. You get a 2% discount if you pay within 10 days. Otherwise, you pay the net amount in 30 days, okay? You could have 1% 10 end of the month or just pay net 10 at the end of the month. 210 net 30 is a very common one. So they paid the balance of the $3,500, huh? They had returned, we originally had a sale of 38 and they returned 300. Now we have 3,500 we owe, but we paid within the parameters of 10 days. So therefore, we're entitled to a 2% discount. 2% of 3,500 is $70. We're going to credit inventory since it's a perpetual system. We're going to credit cash for $3,430. And what we did was we settled a $3,500 debt with only $3,430. Purchase discount. Now, if you fail to take the discount, the discount, you just have to make the full payment. The question now becomes, Derek, should discounts be taken? And the answer is unequivocally yes. In this world of incredibly low interest rates. If you take a 2% 10 net discount, you're actually getting a 37% discount annualized. And here's what we're talking about. You had a $2 discount on $3,500. That means you gave up the money for 20 days, okay? So if we take 2 and we divide it by 98, I'm going to teach it the better way. 2 over 98 gives you a percentage of 2.04. You divide that into a year, 365 days. That's the number of times you earn that interest rate, and you just multiply it out. So the calculation of this is not terribly important, but this is worth a point on the test, I bet, in terms of a question. Should you take the discount? And how much is involved. And here we go. We're looking at the summary of purchasing transactions. We debited inventory originally for $3,800. We had the return for $300 that brought the balance down to $300. We had freight in under the perpetual system that gets added to the inventory. And then we took the discount to pay off the $3,430. Leaving us with the balance of just $150. Purchase transactions. De La Hoya bought merchandise. You debit inventory and you credit accounts payable, and then they return them. We're going to do the opposite. We're going to debit accounts payable and credit the inventory. Record sales under a perpetual. We're still working with a perpetual system. Sales may be for credit or cash. Sales revenue is recorded when we deliver the product. Performance obligation when the goods are transferred from seller to buyer. That gets us back to FOB. When did the goods title to the goods change? There's our invoice again. So we sold something. This being a perpetual inventory system, we get to record both the sale and the cost of goods sold, which you don't do in a periodic system. Under a perpetual system, we're going to debit accounts receivable and we're going to credit sales revenue, okay? And under a perpetual system, we also have to record the cost of goods sold. So we debit cost of goods sold and we credit inventory because that's the asset we gave out, right? Recording sales on account, same thing right here. Here we've got numbers. We had a sale of 3,800 for merchandise that cost us 2,400 to buy. We debit accounts receivable or cash. We credit sales revenue. We debit cost of goods sold, and we credit inventory. Another way to say it is we have a $1,400 profit here. 3,800 for what we sold the goods, 2,400 for what we paid for the cost of goods sold. Sales returns and allowances. Now, here is the way we handle a sales return. You never debit sales. You never debit sales. You never debit sales. You got to remember that. But we have to reduce sales. And the way we reduce sales is with a contra sales account called sales returns and allowances. That's a contra sales account in that it's a sales account, but it carries a debit balance. So what we're constantly doing is saying we have gross sales minus sales returns and allowances equal net sales. It's the net sales that we're always reducing. So here, a customer returns something to us. So we have to reduce our sales by $300 with a debit. We credit accounts receivable because the customer no longer owes us the goods, but we can debit the inventory because we got the goods back in good shape, and we credit cost of goods sold. And what they're saying here is if the customer returns something for $300, but the goods are damaged and we have to perhaps sell them as an irregular, if we think the goods are only worth $50, not the amount we had before, which is $140, you just put it back at what the real value is. The cost of goods sold is determined and recorded each time a sale occurs in a perpetual inventory system only. Perpetual inventory system only. Well, we talked about purchase discounts. Let's talk about sales discounts. They're the same thing, depending on what side of the transaction you are. To the seller, he calls it a sales discount. To the purchaser, it's called a purchase discount. To the seller, it is a contra revenue account. To the purchaser, it's a contra purchase account. So let's take a look at it here. Here is our famous 3,500. Here's our famous 3,800 in revenue. And then there was a return of 300, which brought the balance down to 3,500. There's our 2% discount, $70. Here we go. We received a check in the mail for just $3,430, but that takes care of a total debt of $3,500. The difference is sales discounts. We bought merchandise. We debit accounts receivable. We credit sales revenue. We saw that. And we do the same thing with the cost of goods sold. We debit cost of goods sold for $800 and we credit inventory. Here they're recording a return. De La Hoya returned goods costing $200. That was the selling price. So we never debit sales. We debit sales returns and allowances for $200, and we record accounts receivable because we're not going to receive that money. We then have to debit the inventory and credit the cost of goods sold for the $30 cost of those goods, okay? Now, the next objective, multiple step income statement and comprehensive income statement. Now we're going to have a bigger income statement. We're going to have the data categorized in the single step one. It was just revenues minus expenses. Company does not realize any profit or income until revenues exceed expenses. It's a simple form. And there's your simple single step income statement. What we're going to do now is end up with an income statement where we're going to have not just net income, we're going to have gross profit or gross income. We have gross profit. We're going to have operating profit. We're going to have profit before taxes and profit after taxes. So let's see what we have here. We're going to have gross profit. We're going to have gross profit from not gross profit, but income from operations and net income. So take a good look at the income statement now. Look how it's changed. We have net sales of 2,557. Cost of goods sold now goes up to the top, and it is subtracted from the net sales to get the gross profit. So our gross profit is $1,097,000. That just means that we sold goods for $2,557,000 that cost us $1,460,000. Then we had all kinds of expenses, payroll related and otherwise. Total operating expenses subtracted from gross profit gives you the income from operations. And then you have what are called other revenues and gains, other revenues and expenses. And here they're putting in something called patronage refunds, that which further reduce our net profit. So we have net profit before taxes of $59,000, and then we have $21,000 in income taxes, getting down to a net income. So the thing with the multiple step is you have the multiple. These are the steps. Step 1, gross profit. Step 2, income from operations. Step 3, income before income taxes. Step 4, income after net income after taxes. Bottom line, okay? And here they're just breaking it out a little bit. First step we got sales. We got to get the gross profit. We subtract those operating expenses to get income from operations. Then we have other revenues and gains, which they're putting in here. Other revenue and gains and other expenses and losses are charges and revenues that have nothing to do with what the business does as a core business. PW Audio Supplies sells audio equipment, okay? But they might borrow money, and that's going to cost them some interest expense. As you know, borrowing money is not operating, that's financing. They sold a fixed asset. That would be another example of investing, not operating. So to show in the non-operating section, non-operating, interest revenue, dividends, things like that. These things have nothing to do with buying and selling equipment. These are all ancillary things. They have nothing to do with operating. That's why they're called other. Interest expense, interest is always other. Taxes are always other, and a few others we can think of. So there's our final multiple step income statement. I know in your homework, you're going to have to put a few of these together. Just take a deep breath. You go step by step, divide and conquer. The multiple step income statement for a merchandiser shows all the following except what? Investing revenues, investing activities. That doesn't belong in the operating area. Comprehensive income statement. So here they're giving us an exercise, putting together a multiple step income statement. So let's take a look at what they're giving us. We said divide and conquer. Step 1 are the sales. So let's find the sales. Sales revenue is 462. I see sales discounts. So that's going to have to be subtracted from the 462. I see cost of goods sold, which has to be subtracted from the net sales. And then we have operating expenses and other. So let's take a peek. Well, they want us to put it together. Okay. We'll skip that for just a moment. Let's get into a new paradigm. The periodic inventory system. Periodic. It's considerably different than the perpetual. The periodic system requires a physical inventory every month. You can't get away from it. And we're going to have to take a physical count to back into the cost of goods sold, because we don't record the cost of goods sold or the reduction in inventory with each sale. In fact, we're not going to touch inventory or cost of goods sold even once during the year until the very end of the year or the end of the month, whatever period you're closing. Keep an eye on this formula. This is the most important thing we can learn for chapters 5 and 6, especially in chapter 6 when we get into different methods of valuing inventory. We have a beginning inventory. That's per last year's physical count. We add the goods purchased to get what's called cost of goods available. We might have had 100 books in our bookstore at the beginning. We purchased 900 more. That gave us available books, 1,000. We counted in the inventory 200, which means we sold 800. In other words, the cost of goods available for sale at month end has either been sold or it hasn't. And our job is to put the proper cost into the sales and the proper cost into the inventory. And here is an example of a cost. Here's an example of the cost of goods calculation under the periodic. You don't have to do this under the perpetual method, but we do have to jump through this hoop. We have a beginning inventory plus the net purchases and freight. Freight is part of inventory, remember. That's part of our cost. We add the purchases and the freight to get the total cost of goods purchased. Cost of goods purchased plus the beginning inventory gives us the available. They're telling us that the ending inventory included $40,000. That gives us $316 as the cost of goods sold. And they're giving us another problem here. Let's see if they give us the solution. I wish they did that. Again, we're going to have to look at this. Prepare the cost of goods purchased. Well, the cost of goods purchased is going to be your purchases minus the purchase returns and allowances. Then we're going to take the beginning inventory plus the net purchases plus the freight and subtract the ending inventory. Let's go over the gross profit rate and profit margin. These rates can all be expressed as a percentage. All expressed as a percentage. Possible causes of a decline in the rate. It could be we're selling products with the lower markup. We may have to raise our prices or figure out a way to reduce our cost. Increased competition, maybe putting pressure on our selling price. Or we may have to unexpectedly start paying higher prices to suppliers without being able to pass these costs on to its customers, okay? Gross profit rate. Here's our first metric. Hi, Susie, how you doing? You're mute, Susie. Okay.
Good, thank you.
Okay, well, you can catch up at the beginning of the lecture. Yes. We're going through the difference in we're doing chapter 5, Susie.
Oh, 5? Okay.
5, yeah. Yeah, chapter 5. We fell a little bit behind when I couldn't teach last Tuesday. So chapter 5. And we're talking about the gross profit. Gross profit is sales, net sales minus cost of goods sold. So if you divide the gross profit over the net sales, you'll get a percentage, okay? So here we have sales of $2,557,000. Gross profit was $109. So it was about a 42%. So that means that we're retaining 43 cents for every dollar we sell, just on gross profit. The profit margin. Here's the one that people really look at. You take the net income and you divide it by the net sales, you are going to get you're going to get the net income percentage. Here, the profit was 38,275 divided by the sales gives you 1.5 points, 1.5%. That means that for every dollar of sales, this company retains 1.5 cents. A better way to say it is for every $100 of sales, they retain $1.50, okay? Or $15 rather. So is that a good return? 1.5%? You might say, no, that doesn't seem too good. But interest rates are so low right now, that might be a very nice return on your sales.
Yeah, and they have also such a volume of stores in United States.
They have what?
They have such a large volume of stores, REI.
Oh yeah. No, absolutely. And we have a large tax burden too.
Yeah.
So here they're showing determine the company's gross profit rate. How would we do it? We would simply take 80 minus 40, right? To get the gross profit, 40 over 80 would be 50%. They don't give us the solution. I'm telling you the solution, okay? The net sales were 80 minus the cost of goods sold gives you 40. 40 divided by 80 is 50%. And the next one is also 50%, 120 minus 60. Okay, now we're still in a periodic system here. Record purchases and sales of inventory under a periodic inventory system. Record merchandise transactions. You record revenues when they take place, physical inventory. Under this system, Susie and everybody, you have to take a physical count at the end of the month. You have no choice because we've not been recording the perpetual information. Now, notice one key difference here. Oh, Derek left us. Now, there's a key difference between the perpetual, Susie, as you'll see when you go back, and the periodic. The periodic, we're debiting purchases, not inventory when we buy something, okay? We debit purchases. So we bought something for $3,800. There was a freight charge, okay? SAWC had to pay the freight. The purchaser had to buy the freight. We debit freight in expense. Under the perpetual system, that went to inventory. Purchase returns and allowances. SAWC returned $300 worth of goods to the supplier, right?
Yes.
We're going to debit accounts payable because we don't owe the $300 anymore, right? And yes, we're going to credit purchase returns and allowances. You never credit purchases, okay? Let me emphasize that. You never debit sales, you never credit purchases. You never, ever debit sales, you never credit purchases. What you do debit and credit are either the sales returns and allowance or the purchase returns and allowance, okay?
Yes.
Purchase discounts. Purchase discount. SAWC paid the balance due on account to PW Audio Supply, and they took a 2% cash discount. Now, what you missed earlier here, we talked about the discount. They get a 2% discount if you pay within 10 days.
First
okay?
10 days, yeah.
210 net 30. So what's 2% of $3,500? It's $70. That's the discount. So this customer owes us, we owe these people $3,500, but we can settle it for only $3,430 because we're allowed to take that discount. Okay?
For early payment. Yeah.
Let's record a sale. Well, that's pretty easy. It's the same for all the methods. You debit cash or accounts receivable, and you credit sales revenue. What you're going to learn, Susie, when you go back to the beginning of the presentation, is that under the perpetual system, we will record both the cost of goods sold and the reduction in inventory. We're not doing that under the periodic. That's why you have to take an inventory. Under the periodic method, we're never going to debit inventory. We're never going to credit inventory or debit cost of goods sold until the end of the year. No activity. Sales returns, that's what we were just looking at. Okay, here's sales discounts. This is a piece of paper. These next 2 pages, I believe. You should print, I'm telling everybody in the class, you should print out this page.
Okay.
Print out this page because it shows you the differences between the 2 methods in terms of a perpetual versus a periodic.
Periodic.
Let's look at the one key difference that I think will help you a lot. You notice under the periodic, we buy purchases.
Yeah.
Purchases are a cost. Under the periodic, we don't call it inventory. We call them purchases. Under perpetual, inventory. So wherever you have the word purchases in the periodic, it's going to become inventory if it's perpetual, okay? So that might be a hint to start studying. Under perpetual, everything is going to get put into the inventory directly. Your freight cost is going to go there, and same thing with the purchase discount. Under periodic, we're separating the purchase discount and the purchase returns and allowances, okay? So wherever you see the word purchase, whether it's purchases, purchase returns and allowances, or purchase discounts, change it to inventory. And once you start doing a couple of the homework problems and preparing these different journal entries, it'll start to click in a little bit and you'll be able to study it effectively, okay?
Yes, didn't we already do this?
Now they're talking about adjusting entries for credit sales. I don't know if I want to talk about this or not, but I will. Companies now have to anticipate customer returns. Can you believe that? It's not good enough just to record a return when it takes place. Now you have to guess what's going to happen in the future, believe it or not. So let's take a look here. Rainbow Company sells 100 pairs of shoes for $100 each. And they allow their customer to return any unused shoes within 45 days, okay? So here's the sale under a perpetual system. We sold 100 pairs of shoes for $100. That's $10,000 accounts receivable, credit, sales, revenue, right?
Yes.
Shoes have a cost of $60. So we debit cost of goods sold and we credit inventory. In other words, we made a profit of a gross profit of $4,000 on that transaction, correct? Now, Tanner returns 2 pairs of shoes because they were the wrong color, okay? Those shoes, as we know, cost us $60. 2 shoes come back to us. Under a perpetual system, we're going to debit sales returns and allowances and credit AR. That's the same for both systems. But we're allowed under this system to put the inventory back and reduce the cost of goods sold, okay? So we no longer have a profit of 80. We're back to no profit at all for these 2 pairs of shoes, okay? Rainbow prepares monthly statements and they estimate that 1 more pair of shoes is going to be returned. They're estimating that. So they're going to, I'm chuckling because this is a little weird. They're going to anticipate sales returns and allowances, and they're going to credit what's called an allowance for sales returns and allowance. It's sort of a contra to a contra account, if you will. Then they're going to do the same thing with the cost of goods sold on it. They're going to have an estimated inventory return. So you have an estimated sales returns and allowance offset by an allowance for sales returns and allowance. Then you have an estimated inventory return of 60K value of the product, the cost, and the cost of goods sold. Then when they return something, we're going to use the allowance to record it, to record the return of the sale, and the estimated inventory to record the return of the goods at cost. I'm not sure how much of this will be. I don't think this will be much on the test at all. It's something that you should take a look at just to get an understanding of it. So now they're doing credit sales. That's the same thing. And now we're up to merchandising under GAAP and IFRS. You know, I don't go much into the international world, right, Zuzi?
No.
But what I will say for the test, look for differences. Here's similarities. What are the similarities? There's similarities, but a lot of the questions are going to be under differences. Under GAAP. Under GAAP, we classify income statements by function, like administration, distribution. They do it by different things. Classification leads, they do it by nature or by function. If a company uses the functional expense method, a lot of disclosure is required. That's the only thing I'm ever going to talk about in terms of international.
VAT and IFRS.
Yeah. So that concludes our discussion. Now, Zuzi, do you want to stick around and go back to the beginning with me?
Yes.
Okay. So those of you who have chosen to look at this video, you guys can hit the bricks. I'm going to go back and start over again for Zuzi and anybody else who might pop in, okay? Because a lot of what we were just talking about was gibberish to you, right? Zuzi, you never heard this stuff.
I'm going now to the
What chapter did you think we were on?
Well, I started yesterday.
Hold on one second.
Chapter 8 to write the notes, accounts receivable.
Yeah, but we kind of fell behind. Hold on here.
I don't have the analysis yet. I have to do it today. I had kids sick over the weekend, so it was just life.
Yeah, I know. I'm trying to stop the recording. We don't need to record this part now. Could we do this, Susie? Why don't we get out and go back in again, okay?
Yes.
I'll see you in about 2 minutes, okay?
Okay.
Bye-bye.
Thank you.